In the first quarter of 2026, global markets hit a wall. Geopolitical conflicts and rising inflation created a harsh environment for traditional investments. The impact was immediate. The S&P 500 index dropped 4.6%, while the technology-heavy Nasdaq 100 fell even further, plummeting 5.7%. Many modern portfolios are built on aggressive growth stocks. While these assets perform well during periods of economic strength, they are inherently fragile when global conditions deteriorate. Amidst this downturn, one specific asset behaved differently. The Schwab U.S. Dividend Equity ETF, known as SCHD, surged by 11.8% when including its quarterly dividends. SCHD is a collection of traditional dividend-paying companies. These are established businesses with long histories of returning cash to shareholders. Analyzing why these specific stocks outperformed the market during a global crisis reveals a strategy for managing portfolio volatility. This outperformance results from a systematic three-step elimination rule. First, companies must have 10 years of consistent dividend payouts. Second, they must rank in the top half for dividend yield. The final filter requires proving free cash flow is significantly greater than debt. These strict criteria identify companies with a specific economic advantage called pricing power. Consider a company like Coca-Cola. When production costs rise due to inflation, this ensures dividends can continue to be paid, even during periods of high inflation or geopolitical unrest. Protecting your capital is only the first half. The second half involves multiplying the cash flow generated. This multiplication happens through compound interest. When dividends are reinvested, they begin to generate their own new dividends in a continuous cycle. Imagine a $10,000 initial investment with a 10% annual return. In year one, you earn $1,000. Reinvesting that grows your base to $11,000. Over 7 years, this compounding accelerates. Without adding new capital, the original amount nearly doubles to $19,487. 3 factors determine the strength of this growth: the time you stay invested, the size of your principal, and your annual yield. For the math to work, the investor must never withdraw the intermediate returns. Removing the cash stops the compounding process. Maintaining this discipline transforms a linear savings plan into an automated wealth multiplier. A robust portfolio combines both concepts: an inflation shield through pricing power and a growth engine through compounding. Many strategies recommend allocating 20% to 30% of a portfolio to these defensive, cash-generating stocks to create a stable base. This methodical approach provides a structured alternative to chasing high-risk trends or trying to predict market crashes. When the broader market experiences a downturn, this defensive portion helps maintain a consistent flow of dividends into the account. Combining companies that absorb economic shocks with the math of compounding creates a portfolio that sustains growth through volatile market cycles.